Back in 2021, tech stocks took a bit of a nosedive, and that had a bigger impact on the real estate market than the rising interest rates did. Jeremy Grantham, the investment guru from GMO, is painting a pretty gloomy picture. He's not just talking about your typical recession, he's predicting a full-blown crisis. In this video, we're diving into why he's feeling so pessimistic, breaking down the factors contributing to his outlook, and throwing around some ideas on how to protect yourself from the impending economic storm. To get the real picture of the present market situation and what the future scenario would look like, keep watching this video till the end. Despite some good signs in the US like low inflation, stable jobs, and people spending money, there's this looming concern over a possible recession. The market has a habit of getting too excited about short-term wins, thinking they mean everything's peachy. But even though the government managed to avoid a shutdown recently, there are still big recession risks on the horizon. The New York Federal Reserve is waving a red flag, saying there's a high chance, about 70% of a recession in the next year. Something that's not following the usual historical trends. They're pointing to this wonky thing called an inverted yield curve, where short-term interest rates are higher than long-term rates. The current difference between 3-month and 10-year bonds is more than 1.5%. And that's got people drawing comparisons to the economic hiccups we saw in the early 80s, making us wonder just how vulnerable the US economy really is. Some experts are side-eyeing Wall Street for being a bit too chill about these recession risks, questioning whether the Federal Reserve's crystal ball is a bit foggy, and raising concerns about a potential S&P 500 crash. Now analysts are waving their hands, saying, "Hey, people, pay attention." They're saying the chance of a recession is higher now than it's been in the last 2 years, and we should be getting ready. The collapse of Silicon Valley Bank is like a warning sign for bigger banking issues. Looking at the stock market, some are comparing it to a tipsy person trying to walk a tightrope, showing just how fragile things are out there. A sensitive financial environment is created when a small number of equities appear to be carrying the majority of the market's upward surge. According to 3 very pessimistic S&P 500 crash forecasters, the index may plummet more than 20%, maybe even reaching the October low. In the worst-case scenario, they're referring to a possible drop of at least 45%, a return to the lows below 2,500 points caused by the epidemic. It serves as a sobering reminder of the difficult economic journey ahead. One big factor in all this S&P 500 crash talk is the unwinding of economic bubbles. These bubbles happen when assets get way too pricey and detached from their actual value, setting the stage for a correction. Think back to the dot-com bubble in the late 90s. Investors were throwing money at internet companies without caring much about profits or realistic growth. When that bubble burst, the S&P 500 took a hit, dropping around 50% from its peak. And then there's the housing bubble in the mid-2000s, fueled by subprime lending and sky-high real estate prices. When that bubble burst, it triggered a financial earthquake, and the S&P 500 tumbled by a whopping 60%, hitting rock bottom in 2009. You know, history has this way of repeating itself, but we're not exactly sure when it's going to happen. Well, one thing that could mess with the S&P 500 is if the economy takes a nosedive, or everyone suddenly decides the market is a bad idea. Imagine a significant shift in the financial system or geopolitical unrest that would scare everyone to the point of selling everything. Remember the Lehman Brothers and the chaos that followed? Yeah, that was wild. Then in 2020, COVID-19 emerged, demonstrating to us the S&P 500's vulnerability to unanticipated shocks. 2,500 is the trend line, but significant market collapses might cause it to drop below that level for an extended period of time. When the Nasdaq plummeted by 82% and Amazon suffered a 92% loss in 2000, the Federal Reserve intervened to prevent a 50% decline in the S&P. Fast forward to 2020, and global recession fears and pandemic uncertainty led to a 34% plunge in just a few weeks. Then came 2022, a tough year for Bitcoin skeptics. The cryptocurrencies dropped a whopping 65% due to unexpected crashes in Terra Luna and FTX, along with general economic conditions. But 2023 brought some relief. Bitcoin began to show signs of life in July, even rising by 0.39% to almost $31,000. According to recent reports, Bitcoin is seeing a little decline. However, before we reveal it, make sure to subscribe to our channel and enable the notification bell in order to receive more crucial and unique updates on the economy and finance that you shouldn't miss. The Bitcoin was performing the recovery with a nearly 15% monthly gain, but now it's flirting with a $35,000 mark again. It's currently trading at $35,500 down, more than 48.31% from its all-time high, according to CoinMarketCap. Crypto Town isn't looking so sunny right now. Ethereum whales are also cashing in, with wallets holding $10,000 to $100,000 in ETH, redistributing over 5 million ETH, around $8.5 billion since February. On top of that, Bitcoin's feeling the heat from inflation worries, especially in places like the US and the UK. Some people are saying the recent Bitcoin rally might just be a trap, not a real upward trend. The experts, like Mr. Grantham, think it could bounce back if it stays around $30,000. But let's be real, Bitcoin is still down by 50% from its all-time high. Tough times in the crypto world indeed. If you take a look at the housing market in the US, it's been through a lot, with the Great Depression in 2008 being the biggest hit to home values. Right now, there's a shortage of homes, and more people want to buy or rent than there are places available. Mortgage rates are up, making homes less affordable, and year-over-year home price growth has been slowing since 2022. So it looks like the housing market might be hitting the brakes. The economic bubbles of 1929 and 2000 and Japan's housing bubble are warning that even in good times, like before a bubble bursts, recessions usually follow, catching people off guard. Recently, there's been talk about a global recession linked to a drop in commodity prices, especially food and energy. After Russia's move into Ukraine, food prices shot up but are expected to drop by 21%. Vegetable oil prices took a nosedive by 48%, and cereal prices went down by a quarter in the past year. Now let's shift gears to artificial intelligence. AI and machine learning are boosting productivity and cutting costs for businesses. But if demand outstrips supply due to increased efficiency, inflation could be on the horizon. The ongoing recession is making some people nervous, especially smaller companies in the Russell 2000 with no earnings and high debt. These businesses, already struggling in uncertain times, face a higher risk of going under. A prolonged recession also raises concerns about low returns and a possible bear market, which is when stock prices drop by 20%. A bear market usually brings pessimism and less confidence from investors. Now, there are signs we might be in the early stages of a multi-quarter bear market. Mr. Grantham stressed the importance of a 50% decline in real terms, which could set off a downward spiral. Having housing and stock market bubbles at the same time is risky. Too much growth based on speculation could lead to a big drop in asset values and market instability. China's economic slowdown is expected to affect global oil prices and lower the costs of goods shipped worldwide, leading to deflation. Any more disruptions in China could mess up trade supply chains and financial performance globally. So, what should you do to prepare for a recession during all this uncertainty? Here are 5 proactive steps. Number 1. Invest in quality assets, like companies with strong fundamentals and solid balance sheets, to stay resilient during economic downturns. Number 2. Keep your job secure by staying updated with industry trends and learning new skills. Number 3. Focus on long-term goals that are less vulnerable to short-term market changes. Number 4. Stay informed and flexible by following financial news and consulting with advisors. And number 5. Learn from history. Financial cycles repeat themselves. So, are you prepared for what lies ahead? What steps will you take to safeguard your financial future? Share your thoughts in the comments below. Stay informed, stay vigilant, and take decisive action. If you found this video insightful, don't forget to like, subscribe, and hit the notification bell to stay updated on crucial insights. Thanks for watching.